Another podcast with Investing Education Academy. Today, we're going to be talking about how the Federal Reserve's historic interest rate hike will affect your portfolio. Everybody has been feeling the pinch, at the grocery store, at the Home Depot, Lowe's, you know, at the gas stations. We've all been feeling it, and we've been wondering like what's going on. So we're going to talk about this as it relates to your portfolio today. But we have also, which is a teaser, we're going to be talking about some of the things that you can do if we head towards a recession. Well, it looks like we're heading towards a recessionary environment, but not today. But stick around. We're going to be talking about that. For now, Leon's going to tell you why we chose this topic while I do a little housekeeping.
Yeah, so last week we didn't do a podcast because Brent was recovering from COVID. But something very interesting happened last week. So, Brent and I have been bringing you the information regarding the whole interest rate thing, Federal Reserve thing. It gets kind of boring, gets kind of old, but it is what it is, right? Like this is the main driver, which is affecting the markets, which is affecting our money. So this is very, very important. So last Friday, the inflation number came out for the month of May. And it was terrible. So the thought was that inflation was finally showing signs of slowing, right? So everyone was like, okay, there's gonna be the month. We're finally gonna say, okay, things are kind of coming under control. They're not. The inflation number for last month was actually worse than anticipated, and it took the market it shocked the market, right? Because everyone in the market was figuring, okay, we're finally gonna see a slowdown. Did not happen. Then Monday came, and the market absolutely imploded. The stock market was down about 4%, and crypto got ripped by about Bitcoin 20% on Monday. And I'm saying Bitcoin because Bitcoin is basically the crypto market generally. But Bitcoin was down 20% on Monday. The general stock market was down 4% on Monday, and that's because of that horrible interest rate or inflation number that came out on Friday, which is still at a 40-year high, right? So inflation is still running at a 40-year high. We haven't seen inflation this high since 1981. So that was last Friday. This Wednesday was the day the Fed was going to raise rates, which they did today. Before last Friday, the anticipation was the Fed was going to raise rates by 0.5%. Well, after that number, because the Fed now says they're what they quote unquote data dependent. So as the data comes out, they're going to adjust their policy. Well, the data came out terrible on Friday. Oh, and also on Monday. Also, another number that came out was something that's called the Producer Price Index. This is very important. This actually can almost be like a leading indicator to future inflation because it's the amount that manufacturers pay for their goods. That came in at about, I think it was 10.8% higher than last year. So inflation for producers who make all the stuff that we use, the stuff they're paying for is up 10%, almost 11% over last year. What does that mean? That means they're probably going to pass that cost hike down to us, which is going to mean more inflation for us going forward. So the inflation number last week was just terrible. I mean, it was an absolute cluster that no one saw coming. So what did the Fed do? Being data dependent, they adjusted their plan. So remember, it was going to be a half a point rate cut this Wednesday. They changed that to a 3/4 of 1%. Sorry, I just said rate cut. It was going to be a 0.5 point raise this Wednesday, but they changed it to a 3/4 or 3/4 of 1% raise today. They have not raised that much since 40 years ago when inflation was this high. This was I take it back. The last raise at 0.75 or 3/4 of 1% was 1994, right before the tech bubble started. So we're talking, what is that? Almost 30 years. We haven't had a raise like this in almost 30 years. So what does that mean? Well, what that means, one is that it was kind of telegraphed. So if anyone watched the market today, the market didn't implode when the rate hike happened, because the market was kind of anticipating it, because Monday and Tuesday the Fed was kind of saying, hey, we might go bigger than half of 1%, which they did. So the market was like, cool. Another thing about that is the market, and when I say the market, I'm just talking about the general Wall Street. Everyone on Wall Street wants the Fed to get this out of the way, right? They're like, look, raise what you got to raise, be it 1%, be it 0.25%, be it 1.5%, whatever. Just raise it and get it out of the way so the market can move forward. So, but the Fed, by doing that, they can induce a pretty severe recession if they go too fast. So today they kind of thread the needle, so to speak, raising at 0.75 or 0.75%, which the market liked. Because now what's that showing the market is the Fed is taking inflation serious now. They're no longer so much worried about causing a recession. They're just hoping that if they do cause a recession, it'll be a light recession. And only thing the market cares about right now is getting inflation under control. So today, 0.75% raise. Market kind of liked it. The market didn't implode. It didn't really race up. It just kind of meandered. Now, real quick, last time they did this, they raised.
That was 94. I think.
No. I mean like last month.
Okay.
When they raised by 0.5%, and the Fed chairman said they were taking raising it at 0.75% this round off the table. And the market loved that. That day, the market shot up. But then when the market thought about it, the next day, the market retreated and dropped, I think about like 3 or 4%. So just because the market reacted fine today, you got to see what happens tomorrow. This market is schizophrenic. I mean, it's the most schizo market I've ever seen. The most schizo market I've ever seen. So as of right now, we're good. We're cool. We'll see what happens tomorrow. But that's basically the gist of what happened today. The reason this was important, because you're all like, okay, what does all this mean? The reason it's important is because one, everyone's debt is going through the roof. I don't know if y'all been watching your credit cards, your loans, any debt that you have, if it's not a fixed rate, is rising every month in and month out.
Variable. Variable rate.
Huh?
Variable rate.
Yeah, so yeah. If you don't have a fixed rate but a variable rate, yeah, your rates are rising, right? So pay attention to your credit cards. Pay attention to any outstanding loans you have. If you're looking to buy something now on credit, you may want to definitely check the rate, but you may want to not do it depending on your situation. And I'll give a quick example of how this is just insane. So last week, mortgage rates were at 5.5%. Now a year ago, mortgage rates were at 2.5%. So in 1 year, mortgage rates have jumped by 100%, right? But last week, mortgage rates were at 5.5%. This week, mortgage rates are at 6.2 or 6.3%. So in 1 week, mortgage rates have jumped 14% in 1 week. That is, I don't think that's ever happened in the history of tracking rates. So this shows you how just insane this market we're in right now, especially for the cost of capital, which affects companies hugely. And again, so I kind of get back to what does all this mean? So what does all this mean? What this means is we're going to see more volatility through the end of the year. I made a statement early this year or the end of last year that I was thinking the second half of the year we could have a nice rally because once we're coming out of COVID, and we're the whole thing about rates rising or inflation will subside. Inflation is not subsiding at all. Like it's still at historic rates right now, or historic heights right now. The thesis that I had of that the second half of the year being possibly good, I'm pulling that back now. I'm sitting neutral. I have no idea if it's going to be good or not, because again, that was predicated on inflation coming down. Inflation is not at all so far coming down. These hikes by the Fed will definitely slow the economy. The risk we run is that we're gonna run into a recession, which is kind of needed. I mean, I know everybody hates the R word, but it's kind of needed to get inflation down, because the reason we have inflation is because everyone's out here buying stuff. Like everyone coming out of the pandemic, everyone wants to travel and shop and use goods and have experiences. So we're spending money like drunken sailors, and we're bidding up the prices for everything. On top of supply chains being choked off, so the goods that we want, there are fewer of them. So it's too many dollars chasing too few goods or services. That's why we have inflation. The Fed is trying to rein that in by raising interest rates, so we'll stop spending as much as we are. It'll happen at some point. I don't know if it'll happen this year, but I am definitely drawing back my thesis that the second half of the year will be good, because inflation is not cooperating at all so far.
Yeah. So Leon had a bunch of zingers doing this one today. I just normally I jump in and just add 2 cents here and there, but it was just I was having fun listening. So but you go back to, well, why does this affect my portfolio? That's the question. We all are watching this thinking, how does this affect our portfolio? This will cut into the profit margins of all companies. I mean, Some it may actually have a positive effect because they're what happens is when they get hit with higher costs, they pass it on to the consumer. However, there are those companies out there that are a little bit the morality is different. And so what they'll do is they'll do a markup on top of the markup, which actually leads them to a different level of profitability than they would have been otherwise. And during these raises and or price hikes, a lot of people don't pay attention to the why. They just assume, okay, well, it's rate hikes. There are parameters normally put in place at a federal level to stop price gouging, but a lot of times, honestly, just not enforced. So you'll see some companies go above and beyond what is an inflationary rate hike. Then you have those people who like the Home Depots. If any of you all have been doing work at home, you notice the cost of home goods goes up. If you've been putting gas in your car, you notice that the price of gas is, I mean, it feels like it's 100% increase in the last like 2 months. I mean, I think it's probably in the last 2 months, probably a 50% increase. It went from like 320 something a gallon to 510 in some places.
Mm-hmm.
So all these things are designed to slow down your spending. However, it's not like Leon said, it's not working that way. So we're probably going to see an environment that's pretty topsy-turvy for, I would say, at least another 16, 6, 9, 10 months. Now, with that being said, how you position your portfolio is really important. All those speculative stocks that you were just hoping, shake it up, roll the dice, and hope this thing works. This is not the environment for that. This is not the environment for the SPACs or the company that is IPOing and you just have your fingers crossed hoping that it wins. This is not that environment. However, this is an environment where a lot of stocks that are good quality stocks with strong profitability are pretty much on sale. So what you do from this point on is going to be very important in like 5 years. Again, I want to say this. What you do today, really what you should have been doing last year, but especially what you do today is going to be extremely important in 3, 4, 5 years from now. You're going to look back and either be kicking yourself or extremely happy. So, we give you this information. Hopefully you use it. It's a troubled time for some. It is a celebrated time for others. Leon and I are still getting phone calls from people who are like, I'm so ready to invest now because everything that I wanted before that I thought I couldn't afford, I can afford now. So there are a lot of people who have positions in the market and they felt like they've been just throwing money into a hole or like throwing their money on top of a fire. However, even those individuals have been like, you know what, I'm gonna start dollar cost and average my way back into increasing certain positions in the market. There is opportunity in this environment. Don't feel like it's just a gloomy situation. Everything is just the worst. There is no silver lining at all. There is, depending on what you do with the information we're providing. So, Leon, did I miss anything?
Nah. So, and then just to add on to that, so regarding everyone's portfolios, the market isn't going to calm down or even like start going up in any meaningful way until there's signs that inflation is at least moderating. All the moderation means stop going up. Not mean that it'll stop. Not meaning what I don't mean is that it'll go down. But every month we're seeing month on month, it's 8.6, 8.5. We want to start seeing 7 numbers, 6 numbers, 5. It's going up by less and less per month. We're not seeing that yet. And the rate hikes will have an effect. They will stop inflation at some point. The problem, though, is when rates rise too fast, they typically say the Fed will raise rates until they break something. What they mean by break something is cause a recession. And that's what we don't want. But a recession is necessarily a bad thing. But we got to do whatever we got to do to stop inflation, because stocks will not go up until inflation stops, because the cost of capital for companies is way too high right now. And companies are being hurt by inflation, and they're trying to pass the savings on to us. In some instances, they can't. So that's why we're seeing all this volatility in the stocks that we own, because of these reasons. So the only hope we have right now is that what the Fed is doing over the long term will work. It will work. It's just how long will it take? They took a very strong step today by raising 0.75%. That's a huge raise. We haven't had that big of a raise in 30 years.
1994.
1994, yeah. And a lot of people thought the Fed wouldn't do it. They didn't feel like they had the guts to do it. But now they're showing that they're serious about inflation. Like I said, we may go into a recession. Hopefully it's a light one. But it's either like it's almost the two choices, either recession or continued inflation. They both are terrible. But society cannot live with prices going up by 8% year over year every month. So say to say with our portfolios, like I said before, at this point, we thought inflation would be either moderating or going down. It's not. So the Fed is now stepping up their charge with interest rates, which means we're going to have a lot more volatility in the market, which means the second half of the year may or may not. I was pretty confident beginning of the year. I'm not anymore. That we'll see a positive return by the end of the year. I'm hoping that happens, but I'm no longer that hopeful because that inflation report last week was just that bad, and then the one on Monday for the producers was just as bad. So we're not trying to be all gloom and doom. We're just trying to, we're being real. We're just telling it like it is. Right now, things are not great, but the Fed has shown that they're serious. So I'd say the second half of this year, hopefully we'll start to make back some of these losses. But that's where it stands right now. So hold on tight. Oh, one last thing, and just to make it clear. So like, what can you do? With rates rising as fast as they are, we said this before, just say it again. The sectors that typically do well in this type of environment are banks, insurers, which is insurance companies, and brokerages, because again, they benefit from higher rates. Now, if you've been watching those, they haven't done well either up to this point, because nothing has, right? Like this market is absolutely crazy. But if you're going to buy something that over the long term will benefit from higher rates, it's those three, as well as, and if we go into a recession, big cap tech, it typically does well. The Microsofts, the Amazons, the IBMs of the world, because in a recession, usually consumer is what causes the recession. So consumer spending is drawn in, but enterprise spending doesn't really take as much of a hit. So those big companies that serve enterprise companies don't usually get hit as hard. So those are the things you can do. After going into this potentially recession or at least inflationary.
Yeah, and also look at discount retailers, well-established discount retailers. So, with that being said, we owe you two things, our picks. And I'll say this for anybody who's going to be on our cryptocurrency call, recently Bitcoin's been down by like 30, 40%, like 20, 30.
It was down 20% on Monday alone.
Yeah. So you've probably been thinking like, what in the world is going on? However, we have a currency that's been up 50% this month alone that we're going to be talking about on our cryptocurrency call. So again, if you're not joining that mastermind that we have twice a month, you really should be, because finding a currency that's going up 50% over the course of a month when this whole market has been tanking, yeah. Alternative investments, they're out there. And for those of you all who thought Investment Education Academy was one-dimensional, we are not. So we are definitely looking at alternative investments, and I hope you're part of that conversation during our cryptocurrency mastermind. It happens twice a month. But if you're not, I wish you the best. So with that being said, we're going to put our picks. One will be inside of our Facebook group, so you can search Investing Education Academy on Facebook if you're not already part of the community. And for those of you all who are looking to see what our other stock pick is, it'll be listed inside of our Investing Education Academy platform. So you can go to IA now. You can go to IA now to become a member, or you can go to IAmembers.com to become a member. Either one works. But we look forward to seeing you on our cryptocurrency call. There are some winners out there that you just have to know how to find them. Have a great day, everybody.